Hi, I'm Jimmy. In this video, we're going to look quickly at all of the stocks in the Dow Jones Industrial Average. Our goal with this video is to try to see if we can look at which companies could be overvalued right now and which ones could be undervalued. As many of you may know, I've been looking for another stock to add to my personal investment portfolio, since right now I've only got two stocks in there. I own Disney and I own Intel. I bought Intel at about $48 a share and I bought Disney when it fell below 100. So I'm looking for good, solid companies that could be great long-term buy-and holds. Ideally, I don't want to overpay for it. And right now, there seems to be a shortage of good investment ideas. So what I did for this video is I went through all 30 stocks in the Dow Jones Industrial Average, and then I found analyst estimates for free cash flow, at least for most of the companies I was able to find it for. And then I ran those through a discounted free cash flow calculation for each of the companies, ideally trying to come up with what the potential fair value of that company could be. And then we compare that to the current price of the stock, and ideally we can try to identify which companies are worth a deeper dive. Okay, simple enough. So before I show you what we came up with, if we know, as we go through the different companies, if we know of a reason why one stock is down or why the current price is out of whack with our calculation of fair value, please let us know in the comments below, because this is really the starting point for the research. So if there's anything that you see that you know that perhaps I don't account for, please let me know in the comments below. Okay, so first we have the tickers for the companies, and then we have all the companies. Now, I did leave out financial companies. So Goldman Sachs, Travelers Insurance, American Express, and JP Morgan are not on this list, even though they are in the Dow. I kept those companies off this list because I have found that discounted free cash flow for financial companies tends to not work quite as well. To illustrate that, I've actually left in this top company here, which United Health, which you may know, is a health insurance company, and it doesn't really work. Discounted free cash flow doesn't really work for this type of company, but I left this one in here just to illustrate. Okay, next up, we have the current stock price. Now, you may notice that, one, I pulled this data down 2 days ago, and also I rounded this data. So this top stock here, it's trading at $309 per share. The reason I rounded it is whether or not we bought it at 309 or 309.50, to me doesn't make all that much of a difference, especially since we really only want to get involved in a stock if we think there's a good chance that that particular stock could move significantly higher over the long run. So I'm not too worried about the individual pennies. Okay, now we need a required rate of return and a perpetual growth rate. So for required rate of return, I'm using 7.5%. That's about 5% over the AAA corporate bonds. At least it is ever since they lowered interest rates. I used to use a slightly higher number, used to use 8.5%, but since they dropped interest rates, I thought it's only reasonable that we get a somewhat consistent premium over AAA corporate bonds, so that's why I'm using 7.5%. Then for perpetual growth rate, I'm using 2.5%. That's about the long-term growth of GDP, and that seems like a reasonable number to use. It's a number I've consistently used. Okay, then what I did next is I found as many analyst projections as I could find going over the next few years. Not all companies in the Dow could I find all the numbers for. You'll see here, I'm just going to scroll through these. You'll see if I left the number blank, that's because I couldn't find analyst projections. And in most cases, I went up 4 years of projections, but in some cases, I did stop at 3. So if you're curious about the exact numbers I used, you could pause this video at any point. That's why I'm scrolling through all of them. And if you're curious how to do this whole calculation, I actually did a video on how to perform a DCF calculation. I'll leave a link to that in the description below. I've even created an Excel template I can email you. Again, there's a link to that video. It'll explain everything over there. But with these 4 years of projections for free cash flow, well, we're going to discount those by our required rate of return. And this gives us a total company value. I'll leave that right here for now. And then we adjust these numbers by net debt. So basically, we take the total debt that they have and then we offset it with the cash or cash equivalents that they have. And this gives us our net debt. So we'll take that away from the total company value. So in most cases, this is going to reduce the overall value of the stock. But in some cases like Microsoft or Apple down here, well, they have more cash than they have debt. So that would actually increase the value of their stock. So now we'll clean this up a bit. And now we'll add the net debt company value to this. And then we divide that by the shares outstanding. And this gives us a fair value for each of the companies on this list. In fact, let me duplicate this and move this over so they're next to each other, make them a little bit easy to compare. And then to make it even simpler, let's add the percentage away, the current prices away from our projection of fair value. So anything that is in the red is a negative number, and that implies that that particular stock is overvalued. And that the amount that you're seeing in red is how much it's overvalued by. Anything that's black implies that it is undervalued. Once again, the percentages matter. Now, you may remember that I mentioned United Health just to illustrate about financial companies. And as we can see, well, using basic discounted free cash flow, well, United Health ends up looking undervalued by about 73%. And one of the reasons for this is how we calculate free cash flow. A quick and dirty way to calculate free cash flow is to simply take cash flow from operations and subtract capital expenditures. And for many companies, for most companies, this works very well. But for financial companies, capital expenditures is not a fair representation of the cost of them maintaining their business, which is the main concept as to why that formula usually works. So for us, it might make more sense to do a separate video just on financial companies. Maybe we take a financial ETF and analyze those, do this same type of analysis. If you're curious, again, let me know in the comments below. In that video, we could do more industry-specific valuation methods to try to come up with reasonable numbers. Okay, so that explains that one. Now, when we look at a company like Intel, well, Intel is showing itself to be largely undervalued. And this is actually one of the reasons I personally bought this stock, because some bad news had come out, and I recently did a video on it if you're curious. Again, I'll leave that in a link in the description below as well. But I think that the stock market overreacted to the news that had come out, and the stock, based on their projections of free cash flow, looked like it could be undervalued. Company like IBM, I actually haven't looked at IBM in a while, so that could be worth a deeper dive. Looks like that could be an interesting company. And then you have something like Cisco, again, could be another interesting company to look at. I'm not sure why they're down as much as they are. Boeing is another one that I think looks very interesting, although we really have an idea if we know what's happened to them. I've done a few videos on Boeing, and I think we know why they're down as much as they are, and perhaps it's well-deserved. In fact, I was a bit surprised on one hand that this stock wasn't further away from its calculation of fair value. But on the other hand, well, their problems are directly leading to them having lower free cash flow. So lower free cash flow would lead to lower projections. So I guess I'm not too shocked by the current price. But again, there could be an opportunity there if we're willing to sit in that one for a long time. Okay, now I should mention that we should be careful about taking the fair value, the price that we came up with, and just running with it. The goal with coming up with this type of analysis, with running these types of numbers, is to hopefully try to identify companies that could be worth a deeper dive. What companies do we research next? Like I brought out a second ago, there's a few of them here that could be interesting. And just so we're all on the same page, using, let's say, Microsoft as an example. Well, in this example, we're saying that Microsoft has a fair value of $180 per share. So if we were to pay $180 per share for their stock today, and if we're right about the projections that I had up on the screen before, well, we would earn 7.5% per year, assuming the market valued it correctly. Of course, that's a giant assumption, but as Buffett says, over the long run, the market tends to do a good job. Now, that's the very purpose of using our required rate of return. That's where we got the 7.5% from. If we needed to earn more than the 7.5%, well, we would have to pay less than our calculation of fair value. The further below that we got, the better our return would end up being, once again, assuming our assumptions were correct. And that's why I'm saying we can't just take this number and run with it, because we have to assume that, yes, I hope our assumptions, our free cash flow assumptions, are reasonable, but I don't expect them to be exact. I don't expect them to be, I'm hoping they will be reasonably close. But there's a lot of things that could happen between now and a projection 4 years from now. That is why it's very important to use what Warren Buffett calls a margin of safety. And a margin of safety is when we add some sort of buffer to our calculation of fair value. So if we think the stock's worth $100, we're not going to pay $100. Ideally, we want to pay less than that. And the more uncertain we are about our calculation of fair value, or uncertain we are about our projections, the larger that buffer should be. And if you're curious as to how to come up with a reasonable margin of safety, I actually did a video called When to Buy a Stock, where I go through that very concept. If you're curious, I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.